Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Gautam Tanbay of Springboard coming to us from. Where are you located? I didn't actually ask that question.
I'm in San Francisco, just a few miles down from you.
Awesome. How's what neighborhood are you in? Are you working at home, I'm assuming?
Yep, or living at work, same thing. I am in the Mission, just a block from Dolores Park. Lived here in a rent-controlled apartment for a decade.
Nice, very nice. Yeah. I've had a rent-controlled apartment years ago, and you do everything you conceivable to hold on to it, don't you?
You bet.
One of those crazy things that economists, say shouldn't exist because they artificially skew the market. But hey, if you've got one, you want to hold on to it.
Couldn't agree more. I don't think, I'm not a proponent of it from an economic standpoint, but I currently happen to be the beneficiary of one. And, it helps keep personal burn low, which really helped in the early days of the startup.
Now, have you been going over to Dolores Park, which I've only seen images? Don't they have circles painted throughout the park? Are people adhering to these distancing rules there?
They are, for the most part. What I've seen over the last few weeks is creep. So this number of people in any given circle has gotten bigger and bigger. So at some point when you have 20 people in the circle, are they really adhering to the...
Yeah.
Right. So people stay within the circles, which is, groups stay within the circles, but I've seen the groups get bigger. Yeah,
interesting. There's probably a good correlation between like COVID spikes and circle creep,
I would like someone to do that analysis. Maybe that can be a project and for a Springboard student.
Yeah, cool. All right. Well, so glad to have you and to see you again. Tell us what Springboard does. What do you guys do?
We're an online school that helps people transition into new in-demand jobs and careers. And we guarantee that you'll get a job within a certain amount of time after graduation, or we'll refund your entire tuition.
Wow. Okay. And the categories are, I was looking at it, but why don't you tell us kind of what categories you're educating people on?
For sure. Today, we focus on data science, software engineering, and design. Really where the way we think about what categories to serve people in is we look at where there are skills gaps, which means where does the demand for talent on the employer side far exceed the supply that's coming out of schools or other training programs. Yeah. And that's the opportunity for us to fill in that gap. And really, we think of our mission as bridging the world skills gap. And the reason I went into that long explanation is that we're in these fields today, but we're very much looking at other skills gaps areas that exist in healthcare, that exist, even in non-office-based careers.
And it's all online. So maybe tell us from almost a journey of the user. They sign up. What does it cost me? How long do I spend doing this? Take us through it.
Yeah, totally. Excellent. So these programs are entirely online. They're 6 to 9 months long.
Okay.
And most of our students are considering this as an alternative to something serious like master's degrees, right? So about 45% of our students say they considered a master's program but chose this instead. And really they are career switchers looking to change into a new career. Now, you might be a school teacher who wants to become a data scientist or a UX designer. You might be a barista who wants to break into programming, and because this is a better and higher paying and more stable career. And when you sign up for our program, there's an admissions process. So not everybody gets in, because we want to make sure you have the basic skills that will help you succeed in the program. Because if you don't and we let you in, we're doing you a disservice and doing ourselves a disservice.
Sure.
If you're not quite ready, we might send you to a prep course and say, take this program with us. It's shorter, 4 to 6 weeks, and reapply. But if you're ready, then we'll bring you in. And then you'll get 3 things. The first is a curriculum. About a quarter of your time is spent on consuming content. That's a curriculum designed by experts. The second, which is about 2/3 of your time, 65% of your time is spent on project work, including being matched with real companies. So in a 6-month program, you might be paired with a startup for a 6-week apprenticeship. It's almost sort of like an internship as part of the program, which we help you find and match you with. But also the rest of your time is also being spent doing actual real life projects, because we want you to graduate with a portfolio that you can showcase to employers. That's what employers care about, much more than rubber stamp credentials that comes with a degree, right? And the third piece, which is only 10%, but really crucial and perhaps the most differentiated part of our program, is human support, including one-on-one mentoring from an industry expert. So if you were learning data science with Springboard, we would match you with a data scientist based on your goals. Could be somebody like a data scientist at Airbnb or Dropbox or McKinsey, and this person would work with you one-on-one every week on a video call, answering questions, keeping you accountable, getting you motivated. And similarly, we'll give you additional human touch points beyond this industry mentor, which could be a career coach who's helping you with job prep and mock interviews. You get a student advisor who's checking in on you if you fall behind in the curriculum, and call you and say, hey, Nathan, what's going on? Can we build a study plan together? Let's get you back on track.
Cool. Interesting. And is there an actual degree or certification or accreditation that you get from this, or is just, here's my portfolio of work,
Yeah, there is a certificate, right? At the end of it, you graduate with a certification, but at the end of the day, what really matters much more than the certificate is what can you show to potential employers, and ultimately, do you get a job? And that's where we put our money where our mouth is. We say, we guarantee that you'll get a job upon graduation, or we refund your entire tuition. So we see a $26,000 salary increase for our students before versus after the program. And we see a 94% placement rate within 12 months of graduation.
So can you share what it costs to get my data science certification?
Great question. The tuition ranges between $7,000 and $11,000 for a 6 to 9 month program. You have multiple ways to pay though, including, if you so choose, you can choose to pay only once you get a job, nothing upfront, or a very small deposit upfront, and then you pay once you get a job.
Wow. And I'm assuming you don't have to give numbers, but I'm assuming it's a higher amount if I sort of defer.
Yeah, it's a little bit higher, but really just kind of takes into account the risk that we take on with students. But it's all on our website.
You ever thought about? I forget what startup is doing this, but it's like a loan that you then pay back off your salary. It's like almost like an option on a student's potential future. You ever think about doing a business model like that, which is crazy, but it's kind of clever too?
I think you're talking about income share agreements, which is, people getting a percentage of your salary, the school getting a percentage of your salary. We of course thought about it. And what we found is the model that we have, we call it deferred tuition. So you pay only if and when you get a job, but you know exactly what you're going to pay. So there's no, it's going to be a percentage of my income, which kind of can feel a little bit like indentured servitude. So we don't want that. And when we've surveyed students over and over again, we found that students prefer the deferred tuition model, where you get all the benefits of the income share agreement. You'll pay once you get a job, but you know exactly what you're getting into. So there's not this sort of uncertainty around, if I make more, they'll take more.
Yeah. Interesting. And how did you come up with this idea? Because what's the backstory?
Yeah. So 7 years ago, my sister applied to go to grad school to learn UX design. Got into she was an illustrator, so you don't make a lot of money in that profession. And she got into some great programs and just balked at the idea of taking a $100,000 loan and decided not to go. And just watching her go through that process, I was like, there's got to be a better way in this day and age. Around the same time, my co-founder, Parul, she had just taken an online course, one of the first courses on Coursera, and realized that she was able to teach herself machine learning, which is something she needed to learn for her job, despite having a 2-year-old and a really busy commute and work schedule. And she was like, wow, this is the future of education. So the two of us got together and said, let's build something that really transforms education. And of course, like all startups, we had multiple failed starts. And the first thing we built was a search engine for online courses. We're obviously very different from that. And so we went through multiple pivots and failures and iterations. And yeah, it's, it's a we're a 7-year overnight success story.
Sure. Well, it reminds me a little like all the code academies that sprouted. This is much more advanced, right? I always was skeptical of that. I was like, how are you really a computer engineer after, 2 months of a code class, right? Like sounds much more deeper, much more involved, like much more tangible, right? More meatier, right?
Yeah. Absolutely. Yeah. 100%. I think, and here's the sort of crux of it, right? If you want to learn to build, let's say, a pivot table online, there's a lot of ways to do it. You can go to YouTube. You don't need us. You want to become a data scientist, you want to become a UX designer, that's a hard journey, right? Mm-hmm. It's going to come with pitfalls. You're going to have imposter syndrome. You're going to have points where you want to give up. Mm-hmm. And through those points in the journey, you need human beings to prop you up and support you. And I think what we've done is, despite that, most of online education up until maybe 5-6 years ago was people putting great content online. Right? Yeah. Mm-hmm. Now that's and it's really high quality content. You look at a company like Udemy, they are a bookstore, essentially, like $20 to get 6 hours of content. Or you look at Pluralsight, they are a library, really good library.
Yeah.
In the offline world, you don't send someone to a library and say, go become a data scientist. So why would you expect that online? And so the key is we're building a school, even though it's completely online.
2 questions, and I want to talk about fundraising, but what's in it for the mentors and who's teaching these classes?
Yeah, so that's great. And they're kind of related to each other, right? So teaching, as it turns out, has many different components, right? The first is just consumption of content, delivery of the content to the student. For that, we actually, we use a lot of pre-recorded content, blog posts, even like interactive exercise type of things. And that we find the best content creators and get them to produce the content. It's kind of like a college professor who's using the best available textbooks for their class. But then that's where, there's a term called flipped classroom in education, which means you consume all the content, but then when you come to the live interaction, you're actually coming prepared with questions, and really it's tailored to you where you're stuck. That's the part that's done by the mentors and the career coach. And that's all very personalized to you. And it's what we call the one size fits one approach, right? Because you're going to come, your interactions with your mentor are one-on-one. And so we're really talking about where you're stuck or what your aspirations are, or right. And so it's very different. Now, and by the way, this flipped classroom model has been existent at Oxford and Cambridge for centuries. It just didn't get, right? Like where you have this massive classroom with 500 people, you don't really learn there. And then you go to the tutorial, which is, one instructor and maybe 2 or 3 students. And that's where a lot of learning happens. So then coming back to why do the mentors do it? We compensate the mentors with an honorarium, but money is not their primary motivator almost always. It is giving back to the student. And this is one of the sort of really counterintuitive insights that we've discovered. 4 years ago, if you'd asked me, I would have said scaling mentors is going to be the hardest part of this business. We have today 1,000 industry professionals mentoring on Springboard, top professionals at, again, you name it, like Facebook, Airbnb, Google. And what we found is one of the hardest things about scaling schools is that it's really hard to scale instruction because often the best professionals in an industry don't necessarily want to teach. Here's the catch. They don't want to teach full time for 40 hours a week. But if you create a way for them to teach 3 hours a week from the comfort of their couch in their pajamas on a Thursday night, absolutely they want to do it. And that's in some ways we're unlocking what one of my colleagues likes to call Airbnb for people's brains. There's unused capacity, and we're just enabling people to be teachers who otherwise wouldn't be teachers. So yeah, it's giving back. It is access to a talent pipeline. A lot of people say I get better at my craft when I teach. And it's very selective. We select 1 in 10 mentor applicants, so people feel sort of this pride and there's a sense of, it's a badge of honor.
I like it. How much have you guys raised and over how many rounds?
We've raised a total of $53 million, including our most recent $31 million Series B that we closed and announced last week.
Yeah, congrats on that.
Yeah, and number of rounds is kind of funny, like fundraising has become more of a continuous process. But if I had to categorize them, I'd say we had a couple of seed rounds, which really were a series of safe notes stacked on each other. Right? Then we had a Series A, then we had a series, what we call post-Series A round, which was a top-up on the Series A, and then a Series B. So I'd say 5 rounds if you really had to categorize it.
Yeah, interesting. What let's I guess go chronologically on the seed round. How did you kind of put that together, and maybe did you worry about stacking a lot of safes on top of each other? Was that ever a concern, or if you can talk about that at all?
Yeah, great question. I mean, the seed round really was, like I said, multiple safe notes over time.
Yeah.
One of the best things about that was that it made fundraising a continuous process instead of a discrete process, which on one hand is more exhausting. On the other hand, we didn't have this sense of like, wow, we must raise this much money or we're out of business. We could operate at that time with sort of always 6 to 12 months of runway.
Yeah.
Up until we had really strong product market fit and had some traction to show for it and go raise a Series A. The flip side of that, by the way, is while it sort of takes some pressure off of fundraising, it does organizationally it doesn't train you to make longer term decisions. And so when you raise your Series A, now you've got 2.5, 3 years of runway, you're like, you just need to reorient a little bit. Because you're making, you're not making that important hire because you've got like 9 months of runway and you can't. So yeah.
Was it a conscious decision to sort of be doing that sort of continuous process in the seed round, or was it just you weren't quite at product market fit, so that's how it had to happen?
Yeah, that's a great question. It was a bit of both, and I'll tell you why. I think the first time around we tried to raise so it's really funny. The first set of checks we got were from people who happened to be angel investors, but also knew me or my co-founder or both of us for a long enough time that they were really making a bet on us. And that was inbound. That was like $300K, which was given to us inbound. So we were like, wow, it's easy to raise money. We go out to raise our next round, which is supposed to be $1 million round. I made the mistake of starting to raise in mid-November. Don't ever do that. Because literally people, we didn't get our first commitment until early January. And, I just thought I was doing something completely wrong, which I'm sure I was, but also it was just the worst time to be raising money, right?
Yeah.
And so we barely kind of scraped together, I think it was $560K as we were trying to raise $1 million round. Of course, and then doing those dance with investors who've committed, say, $100K with the expectation that it's going to be $1 million round.
Yeah.
But it's not quite there. And that was hard. That was hard emotionally. That was hard. It was exhausting. But then somebody was like, hey, you know what? You've got this $500,000 committed. Why don't you just call this the round and just go raise your next round sooner than you otherwise would? And that's sort of how the first time I was like, yeah, why are we married to this $1 million number? We don't need this money for 9 months.
Sure.
Let's just go raise again in 6 months. So that's kind of how it came about. And then it sort of became a strategy. And so the caps on our safe notes ranged from $4 million, which was the very first inbound, to $20 million, which is great because we actually were able to contain dilution. I think we raised our first $3.7 million over time, over a period of 2 years, for only 25% dilution. Which again, today is common, but back when we started in 2013, that was, we ended up doing really well for dilution.
Can you maybe abstract or extract from that a bit of advice or tip for founders in how you approach that? Is basically just trying to negotiate lower caps to, can you extract a tip from that?
Yeah, totally. I would actually say, and maybe it's not from the caps, but it's, I think, the most valuable piece of advice I got when I was facing rejection after rejection. I had a couple people who sort of signed up, but you go, and the nature of seed fundraising is you talk to like 50 people, maybe 4 of them will like throw their name in the ring, maybe 10 will. Is that 2 things actually? Fundraising is not an exercise in convincing the people who don't believe right now, and I think that right now is important too. It's an exercise and it's a search. It's a search for the believers. Right? Yeah. Who believes today? And if we treat it like that, it's a change in mindset. Because then I'm like, you know what? this person doesn't believe right now. That's okay. This is not rejection. I'm not going to try and convince them. Let me move on and find the believers. And when you start treating it like a search, it's game changing. And then the other thing, the related thing I would say to you is, don't assume that a non-believer today is going to remain a non-believer always. Almost in every round, we've had somebody who said no previously come back and invest, including in the Series B, $30 million Series B that we just closed. One of our investors has been saying no to me for 6 years.
Yeah. I want to come back to that, okay? Because that's really interesting. But let's just touch on the Series A just for a quick minute. So, kind of, at the Series A point, did you sort of shift gears into like a more formal, discrete process?
Totally, and yeah, totally. So we had a process, and we had a failed attempt and then a successful attempt. And so I'll talk about the successful one because there's lessons in both. Absolutely, you want to run a process. You want to keep everybody on the same schedule. You want to stack all your first meetings in the first week or two, and you're probably doing like anywhere from 20 to 40 first meetings. So you're doing 4 to 5 meetings a day. It's exhausting. But you want to, the tighter your process, here's the thing, you've got to kind of learn the game because investors are playing the game every single day. You play the game once in 18 to 24 months.
Exactly.
But you kind of have to learn it. And it was never my favorite thing to do, but over time I got good at it.
Yeah. Yeah. No, that's awesome. That's awesome.
Actually, one critical thing about the Series A versus the seed that I'll say is, when you're raising a seed, you're trying to convince an investor to, take one of maybe 25 seed checks they will write in the year and kind of, place a bet. When you're raising a Series A, you are trying, a partner at a VC firm is going to do 1 to 2 deals a year.
Yeah.
Which means over a course of a 5-year period, they will do maybe 10 deals.
Yeah.
Right. And you are convincing them that you are going to be one of their 8 to 10 career bets, which is going to make or break their career. It's a different stakes and it's a totally different conversation.
How do you, given that, how do you sort of approach them, or do you change anything in knowing that you could be one of their deal makers or breakers? Do you change your pitch at all, or is it just, again, searching for those believers and kind of finding the match?
I think it's still a bit of searching for the believers, but you really want to do a lot of diligence up front about which partner at the firm do you want to talk to, because it's very possible and even likely that one of the partners at a firm has a thesis. The thing is, if you get rejected by one partner, I think that firm is closed for you for that round.
Yeah.
And so you want to be really strategic about who you approach in the first place, because you want to create somebody internally who has got excitement about your space and will go to bat for you. And I think who brings the deal in, who first sees the deal, impacts the likelihood of whether they will bring it into their partnership or not. So you want to be right, because like, let's say you and another partner have a VC firm and you just like don't believe in education. Now, this is not your area of expertise. You have other deals coming to you in B2B SaaS, and that's your primary expertise. I come to you, you're like, this is kind of interesting, but not my area. I'm going to pass. And in a 2-person firm, it's less likely to happen because you might give it to your partner if you knew, but in a 10-person partnership, it may never get to the right person. But once you get a no, you can't go back channel and find somebody else in that round. Yeah. So just do your diligence up front about, I guess the pithy sort of one-liner there is do your research on not just on which firm you want to work with, but which partner you want to work with.
Yeah, absolutely. Absolutely. Cool. I like it. Let's go ahead to the Series B, the most recent round. And you just closed it. Now, did you start it like in the middle of COVID, or when did you start raising this?
Yep, we started raising on April 1st.
Oh my gosh!
Which is literally just as the world was going to the doghouse.
Absolutely. So did you? Yeah, because by March things were already really bad. So did you think about retracting? However, your business seems like a COVID play in many, many ways, right? Like, so give us your thought process at the time of like, do we lean all the way in, or do we take a pause from this? Or
that's a great question. So we had planned to raise in Q2, that well before COVID happened. That was the plan. And we started to socialize the idea. Actually, starting in November or December, I was starting to, talk to people about, hey, we're not ready to raise, but I'm happy to tell you the story. We're not going to share any materials. If you show a deck, they assume you're fundraising, so don't show a deck. Just have a conversation, meet them for coffee, and really genuinely build relationships, right? Like genuinely kind of take time to get to know each other and get a sense for, is this the kind of person who would be a fit with what we're trying to do, and will they add value? And that's actually much easier to do outside of the fundraising treadmill.
Yeah.
Because then you're actually meeting as equals. I'm not trying to pitch you. I'm just trying to get to know you. And so we did make those investments ahead of time.
Let's talk about that. I'm sorry to interrupt. Let's talk about that a little bit, because I think that is a key thing that people like. So what does that mean exactly? Don't show a deck. So is it literally just, can we meet for coffee and I'm telling you what I'm doing? Like, what's sort of the details there?
Yeah. I think the best way, great question, right? The best thing what you want to do is you want to get a warm intro to the person. Now, by the time you're at Series B stage, you probably, especially if you're based in Silicon Valley, but probably even if you're not, you've done enough kind of fundraising and you've gotten to know enough founders over time that you're probably 1 degree separated from most VCs you want to talk to. But you want to get a warm intro. You want that person who is introducing you to say, hey, these guys are doing something really interesting. Here's why I think this could be a fit or interesting to you based on these things that you've done in the past, like these similar deals or your thesis that you, or a blog post you wrote. I think you guys should get coffee. And they, by the way, they're not raising right now. I'll just be very clear about that. And then when you start talking, you say, same thing, you reinforce that saying, Nathan, we're not raising. But I've heard great things about you. I really like some of the things you've done. I read this post by you. I think it's inspiring. Would love to meet and build a relationship ahead of when we are ready to raise. And I'm so very explicit about that. You don't have to sort of dance around it. Just say, not raising. But, when we, and almost sort of what I say, and this is true, is, when we run a process, it's really tight and we don't bring everybody into the process, right? So in fact, I'd rather do 40 coffee meetings and eliminate maybe 15 or 20 people and only bring in the 20. So in that sense, you're also indicating to them saying, hey, it's not a given that you'll be in our process. And this is not like we're not trying to play a game here. It's genuine. And so let's have, and most VCs like that, and they are open to that. And, they because they also want a leg up when the process starts.
Yeah, absolutely. So I love it. Okay. So you start socializing it in November for a Q2 raise. Q2 comes around, COVID hits. Now again, April 1st, you're like, all right, screw it. We're gonna do this anyway, come hell or high water. What was
Yeah, no, that's a great question. I think the reality is when COVID hit, we had reason to believe that our business might have tailwinds, just based on historically how education businesses have done, based on some early indicators we were seeing, but we weren't sure. And so we didn't know how it was going to go. And we also didn't know how the pandemic was going to turn out, how long it's going to last, and how long the recession is going to be. So our instinct was, you know what, there's uncertainty on multiple dimensions. Can you hear the crying baby, by the way?
A little bit, but you know what? It's the middle of shelter in place, and
all right,
darn it, we're gonna.
It's just background music.
This is how things are these days.
There you go. Yeah.
I was on a call just earlier today, where we took the dog to the beach yesterday. She drank too much salt water. She was throwing up all night, and so I was on a call with like a dog sick in the background. That's just how things are today. You know what?
welcome to the new world, right?
Yeah.
Thanks for bearing with it. Awesome. So we said, there's just so much uncertainty.
Yeah.
Let's just go and attempt a raise, right? Our numbers were really strong coming in to COVID. And we said, listen, like if they get better because of because of tailwinds, that's going to make things a little bit better, but we're not sure about that.
Yeah.
In hindsight, we were right, but let's just go and get some certainty, right? Like let's minimize uncertainty. And so we said, let's go raise. And worst case, if we are not able to raise, that's also information in the system. And that's also valuable. So let's just go get some information.
Yeah. Interesting. And I guess if you're able to share, like, did your business take a hit, or did it actually like grow, have the
Yeah.
opposite effect where it started to really get a boon?
Yeah, we were fortunate. So we've been fortunate to really have, those tailwinds did materialize, and we've seen that absolutely there's an uptick in number of people looking to do career changes, especially given we're seeing some of the largest labor market shifts we've seen in over a century.
Yeah,
and also anybody who was going to go to school in person now has no choice but to go online. And so both of those tailwinds have actually been very beneficial for us. Of course, we didn't know this at the time when we started raising. It did help in the process though, because, as you get through the process, you want, again, for VCs like to invest in lines, not dots, right? So that you want to see multiple data points, and you have a first pitch in middle of April. And then by the time you're meeting that partnership in May, you've had one more month of data and say, oh, by the way, things are going as we had predicted. That builds a lot of credibility.
Yeah, that's amazing. I just had a call right before you with an intern or potential intern candidate at Brown, and he just deferred this year, taking a gap year, and he's going to get online and like teach himself coding and a bunch of other stuff. So I'll send him your link. Maybe you'll have a new customer.
There you go.
Very cool. You mentioned one of your Series B investors had told you no for a long time. How did you flip that person, and or why did you keep them in? If someone told you no way back when, why did you even keep them in the loop? Yeah,
that's a great question. Well, I think this is something that's really valuable in fundraising, but I think also really valuable in life and business in general, is when someone says no, you want to take it seriously, first of all. Like, you don't sort of, when somebody says no, they've then done their thinking, and so it's very rare that you're able to sort of turn that around and convince somebody to say to say yes when they've just said no.
Yeah.
But it's a not now.
Sure.
Right?
Yeah.
A no is always a not now. And I think one of the mistakes I've seen some founders make, or even I've made, we've made that in the early days, is when somebody says no, you go back to them and you think it's persistent, and I'm going to say, no, I'm going to try and convince you right now why you're making an incorrect decision.
Yeah.
That almost never goes anywhere. Right? And what you want to do instead is, okay, that's great, thank you. What are some things that are causing you to say no today? And what would you have liked to see, or what you'd like to see in a couple of, in a year or two, that might make you rethink your decision?
Yeah.
And just get that information, write it down. Thank you for your input. And then, go back in 12 to 18 months and see if you have showcased some of those things, and then go back to them and give them a call.
Would you keep them on like a newsletter distribution list or anything? Or would you just when it's time to socialize your next round, would you just kind of, hey, let's go up?
Yeah. Some people do newsletter distribution lists. I think that's smart. We just never have had our shit together, for lack of a better reason, to that extent where we've had that, that organized degree of organization. And again, it's very founder to founder and personal. Like, I'm very organic in how I build relationships. So, I'm usually will leave things with you at a good enough note that even if like 12 months from now, I pick up the phone and call you or send you a quick note, as long as there was a mutually positive interaction, you'll be like, hey, I want to hear more.
Yeah.
So I keep it organic, but I do think that newsletters can be very effective, and I've seen founders do that very effectively.
Cool. One or two more questions. I'll let you get back to it. But, you had some tailwinds. You decided to go for it. Any other things that changed, or either things that changed in the fundraising market during the COVID period, or that you did differently to kind of, deal with COVID? Yeah,
totally. So first of all, I didn't just, because when we were raising, I think this has changed since. When we were raising, everyone was just scared.
Yeah.
And you could tell, right? So one of the things I did, and I think people were also trying to figure out what this means for them. So I was very upfront about qualifying people, right? I wanted to speak to somebody. I mean, most of our introductions were to senior partners who could write checks, but especially if the first call was with somebody who I didn't believe had check writing authority, I would just have a very candid conversation with them saying, hey, how do decisions happen at your firm? Who are the decision makers, and it's like a sales process, right? And sure. and who would be the partner who would sponsor this deal, if at all? And can we speak with them sooner rather than later? Because what we don't want is, both you and I to spend a lot of time and only to realize there's nobody sponsoring it internally.
Yep.
Right. So I would sort of frame it as this is beneficial to both of us. That's one thing. The second thing we did in terms of qualifying is I asked point blank, and I said, because if you ask people, are you investing right now? Everybody would say yes.
Yeah.
Instead, I asked people, okay, has your firm issued a term sheet since COVID? Right. And then the second question would be, if they said yes, did that process and that introduction with that founder CEO happen before or after COVID? So have you actually written a term sheet to somebody you've never met in person? And you'd be surprised how many firms said, yes, we are open for business. But when you ask them these qualifying questions, they said no, they dropped out. And then I would just deprioritize them in terms of how right? That's changed since I think most people have found a way to do business. The other thing that changed was the pitch. So, one of the things about pitching on Zoom is you need to be much more interactive.
Yep.
Because, if you've ever sat in front of a Zoom presentation, right, like it's like a webinar, it's really slow and boring. You don't have the ability to engage and energize the room as you would in person. So one of the things we did is, instead of a, typical 10 to 20, 15 slide fundraising deck, we actually built a 55 to 60 slide deck with lots of like small animations and things. So not a lot is changing. And so each slide was like a very crisp, like 30-second concept.
Wow.
Versus, let me have one massive slide with lots of like detail and bullet points on unit economics. Let me just show you. For example, one thing we did, for example, was we had this like 30 slide loop on the user journey that I would walk people through in like 5 to 7 minutes, really sort of taking people through the experience from the lens of an actual student and telling a story.
Yeah.
And so now you've got people engaged and kind of get the heart rate up a little bit, and they're not, because you need to do something to get them to stop looking at their phone.
Yeah. Yeah.
A couple of other things I would do is I'd lay ground rules up front. Like, for example, I had first couple of pitches, I had people where I'd be talking to 3 people and 2 of them had their video off. And I would just call that out and say, I would just say it's really hard for me to get feedback already in a Zoom world, right? I want to see what you're absorbing, what you're not, and be able to respond to that. Yeah. And to make this more effective for you, can I request you to turn your video on if that's not too much?
Yeah. Yeah, that's good.
Because it's demoralizing to pitch to a bunch of like static screens.
Sure. Yeah. Good.
Yeah.
What else? Any others? These are great.
Yeah, I think, and finally, the other thing that actually was a positive in the Zoom pitching world, even though it's sort of, is you can completely control the environment. So you don't have this thing of like, I walked into the, firm's offices, and then of course the projector didn't work, the classic, right? Like here, you can really, you can do the exact same thing down, I literally had my timing down, saying at, 12 minutes past the hour, I need to be in this section, and at 17 minutes past the hour, I'm going to raise this question and see what response I get. So it actually, in some ways, lets you really control the process a lot more and really productionize it, if you will.
Interesting. Yeah.
Yeah. And it also, it's much easier to practice. You can actually have, it's easier to have, for instance, somebody who is observing you or a note taker. Because, you bring somebody else on Zoom, it's not as noticeable, versus if you bring somebody in to the room, then, if that person doesn't say anything, there's questions. So I think there's a lot of benefits. And frankly, you can do more pitches in a day.
Yeah.
Yeah.
How many were you doing in a day during like peak pitch season during
COVID? So, this is where my EA, he's a rock star, and he just had so much support from him. But we sort of structured this thing where I would keep a day and a half for internal stuff, because, the business also needs me. And then 3.5 days I was pitching, and I would do 5 is the maximum I would do. So I try to do between 4 and 5. Some days I did 6, but it's, by the 6th one, you're not that effective. And so basically the way we structure the day is our pitch, 30 to 60 minute break, our pitch, 30 to 60 minute break, because what you want is a little bit of time to absorb what happened, take notes, and then gear up for the next one.
I love that though. I love when you can quantify stuff like what you just said, though. You had a day and a half each week for your business and 3.5 days for pitches and focus on fundraising. I mean, things like that are golden, right? Founders don't realize that's what it takes to raise a $31 million Series B.
and much longer days, by the way, right? So it
Yeah.
was again than I would normally have. So because then you do the pitches, but then there's a lot of follow up. So
Yeah.
typically, what I would be doing is, usually 8 a.m. to 6 p.m. I would have my normal work day, and then between, I'd say, 8 p.m. and 11, sometimes midnight, I was doing a bunch of follow-ups. Because, especially as you get later in the process, you start getting data requests and they get pretty, and by the time, I think it's also worth calling out, raising this size round at this stage, it's not a solo effort. It's really, and I don't mean, it sounds trite, but really, I had a team supporting me. I had our head of biz ops who was just owning the due diligence process. So we'd get these DD questionnaires with like 15, 20, 30 questions from a VC firm, and we'd get like 4 of them, 4 to 10 of them every week. And I would lob them over to Eric and say, hey, can you take a first pass at this, right? We had the whole data room ready to go at this stage. You can't just, it's no matter how well I tell the story, at this stage, the investors are investing in the business and the metrics. The story just gets you the ticket to play.
Yeah.
And and then, like I said, my EA was just like, setting up all these interactions. And of course, our entire exec team needs to get involved because, as you get later in the process, they want to talk to different members of your team. And finally, even in terms of the closing process, of course, our counsel and my chief of staff, and there's sort of a real, it's a real team that makes it happen. I just play one part of the role. Like I have a role on that team. I'm not, versus like a seed round, my co-founder and I would just go and, talk to some investors and with a deck and maybe send them like one spreadsheet with data, and that was done.
Yeah. Right. Yeah. I was going to drill into the team a little bit. I think you've covered that, but basically your EA, biz ops guy helping due diligence, and then bringing other folks in as needed, basically. Is that a summary, or are there any other key players?
I mean, my co-founder, of course. So basically the way we've divided responsibilities between us is I tend to do the first a lot of the earlier heavy lifting on the fundraise so that we really protect her time and almost use her as a card saying, you don't get to meet my co-founder until you're far enough along in the process that we are serious. And it's almost sort of like, it's enough for one of us to spend a bunch of time on fundraising. It would be a travesty if both of us did, right? So, But then in the final, almost always the last step at most firms is this partnership presentation, and that would always be she and I together.
Yeah, interesting. All right, last question. I'll let you get back to running your business, but any other tips we haven't covered that you'd like to share, or any advice you would give your younger self, and you can choose what that means if you're doing this all over again?
Yeah. Wow. Yeah, I think the advice I would give my younger self is just it is a marathon, not a sprint, and just buckle in for the long haul. And like if somebody had said, to me 7 years ago, that it would be 7 years before we get to the stage and I would still be doing it, I would have laughed. And the reality is there is no overnight success. Sure, there's 1 or 2 here or there, but most overnight successes are a long labor of love. And so just, and on that note, like take care of yourself because it's going to be a long haul, right? Like just take care of yourself physically, mentally, emotionally, make sure that you are treating this like a real, marathon or even a series of marathons versus I'm going to sprint a couple of times. And right. So just, treat yourself well, take care of yourself, take care of the team.
Yeah, absolutely. I love it. So much good stuff. Tons of awesome notes here. If people want to learn more, it's just simply springboard.com, correct?
That's right. Easy enough. Springboard.com.
Anything you want to promote or plug, open job recs or anything, new classes coming online?
Thank you. Yeah, we just closed it around. So we're hiring across the board. And really we're looking for mission-driven people who want to make a positive impact in the world. We just put in place at the start of the year a 10-year goal to transform 1 million lives by 2030, which is to put 1 million people into careers they love. And so we're looking for people who want to share in this mission, and we think it's more important than ever right now as we see these labor market shifts globally. So we're hiring. We are, and then we're looking to partner with businesses to start bringing some of our what have been historically our B2C offerings into retraining within the enterprise.
Sure.
So if folks are interested in learning about that, I would be happy to take part.
Very cool. All right, Gautam, this is just awesome. Thanks so much. Congrats on the round, and we'll catch you after your Series C. We'll see how things have changed at that point.
Sounds good. Or, we just get to profitability and never raise money again.
That's a nice way to do it too, right? Yeah.
All right. Yeah, I wish there were how we got to profitability in addition to how we raised it.
That's not a bad actual spin-off. Maybe I'll think about that, like how we hit cash flow positive or break even or whatever it is. Yeah, that's good.
There you go. All right.
All right, sir.
Awesome.
Thank you very much.
Thank you, Nathan. Yeah, take care.